Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there. Let's take a look and see what people are sharing. I also shared some stuff today too, so we can go over all that stuff. If you want to follow me on the website here, so it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics, answer your guys' questions on the weekends, have midweek updates on Wednesdays, sharing what I'm doing, how I'm playing the bull market, the companies I'm buying. You get to see exactly the pricing I am getting, and there's nothing really being hidden on the website at all. You can see exactly how I'm positioning for the bull market. So Norman did reply, and I know when you retweet stuff, it goes from the last thing that you retweeted, but um, I do appreciate people looking at things differently, so it gives me an opportunity to look at things differently. What he did is he says it can resemble a pattern, and basically he's got a resistance support level, and he just drew these things on there. Um, I'm in the camp that this is probably going to go lower, a breakout to the downside. What that would signify is that gold would outperform the S&P 500. He put these lines on here. Maybe he's signaling that this is just a resistance point that we're about to break to the upside. Potentially, this is a rising wedge that generally breaks downward. So he put those on there just as saying those are some resistance levels, and maybe we can break potentially that resistance level up, or maybe we cycle back down to the green and or even gray levels. What I've got here is I said yield curve inversion and late cycle expansion phase. So when we get into the expansion phase, generally what we see is a inversion of the yield curve. So when this goes up, the yield curve's inverting. We can see in history that we've had a couple of inversions and then uninversions. The uninversions is when you have problems in the market. The inversion portion is when the market is going into a expansion phase of real estate, and then the curve can stay somewhat inverted for a long time. Possible. We had a pretty long inversion in the 90s. We had another inversion coming from 2004 all the way up to 2006 and 7. That was the peak of the real estate cycle. We saw a clear downward move in 05, 06, 07 in home builders. It was clear as day if you look at the charts. A lot of them put in head and shoulders topping patterns. We also saw inventory increasing during 05, 06, 07, quite dramatically too. We also saw construction spending for residential go down. We saw unemployment go up. Basically, all of the red flags were there. We had foreclosures rocketing higher. To me, that was a pretty obvious slowdown in the real estate cycle. We had another yield curve inversion occur in 2016, 2017. In 2018, it peaked, and then we had a massive move lower during that 2020 move. People had run into bonds dramatically, almost like they knew that something was going to be shut down. So that's where they all piled into the 2-year, and yields dropped. We had another yield curve inversion, a pretty big one, pretty fast too, from 2020, about August, September of 2020, all the way up to where we are today. And right now, the yield curve's inverted. That is analogous to a late cycle expansion phase. That's where yields remain at a high level and they go sideways. That, when we get to certain portions of this cycle, that's where certain assets are preferred. So when we come down, that is generally preferred to be in bonds. When we bottom, A lot of the times you'll see a big move off some of these bottoms, either in commodities, depending on where you're at in the commodity cycle overlaid on top of it. Sometimes technology stocks do very well as well. And now I'm surprised that technology stocks are still running as well as they are with some of them. And maybe that's just a small sector or area in it. But this is usually a great time for energy to rip, is the late cycle expansion phase. And I'll show you some more data below of what other people think and where we're at in this cycle. I'm fairly confident that's exactly where we're at, given where the yield curve is located. So you can use the yield curve and where it's located to tell us where we're at in the cycle. So here we've got Grady. He says this ratio chart shows how historically undervalued small and mid-sized commodity companies are versus the commodity index CRB. And he's got the Canadian dollar versus the CRB index. It's got a false breakout here in 2024, 2023, and we're at a really low level. This here coincides with this here. They're all interconnected. So when this falls or stays elevated and then eventually falls, it's generally when the dollar goes down. It's when these yields here go down, and they go down at a faster pace than other monetary currencies. Right now, since this went up, see how that went up in the yield curve and inverted? It means that the dollar is going to be strong and that the yield curve inverting means that interest rates are going up. The short end is going up faster than the long end. That's what caused this big pullback here in the Canadian CDNX versus the CRB index. It was that large move from 2021. That's right here, 2021. This big move is what caused this downward move in this ratio. It was the strength of the monetary tightness and the strength of the dollar against the Canadian dollar when looking at this ratio. Because CRB, it's not going to rocket too much if the dollar is strong, and the CRB index is priced in dollars. It says far more money has been lost by investors trying to anticipate corrections than has been lost in all the corrections combined. One of the worst mistakes you can make is to switch in and out of stocks or stock mutual funds, hoping to avoid the upcoming correction. So in his opinion, which is Peter Lynch, is one of the better investors, I would say, of all time. He says don't try to time the corrections. Stay in, ride through it, and get to the other side. If those market conditions change, they generally change pretty rapidly. They don't last forever, and the pullbacks may not be as big as you think. And that's where people get tripped up. They're trying to time things in the short term. They mistime it. The pullback wasn't as big as they expected. They never got back on board. A lot of things can mess up. You have to make a lot of right decisions. You have to make a correct selling decision and then another correct buying decision and have it be worthwhile. So the pullback has to be large enough for you to cover your taxes if you have gains. And most of the time, doing all of those decisions nets you more of a headache than it does timing the market correctly. So he says don't do it, basically. He says ride through it. Add if you've got good opportunities to add into undervalued assets and just ride. That's I've adopted a lot of that in my investing and my approaches and strategies. The business cycle update from the Fidelity website, and I'm trying to gain some other insights on maybe where people think we're at in the business cycle. So I checked this. I own a Fidelity account. This is second quarter 2024. The global business cycle is prolonged expansion. So it says many major economies, including the US, remained in the late cycle expansion phase and registered hints of stabilization and even reacceleration in some areas. Expectations of monetary easing have contributed to improving global financial conditions, and worldwide manufacturing activity has firmed. China remains the outlier as it continued to ease policy in hopes of reaccelerating from its growth slump. So they're in a recovery phase. They went through the contraction, China is. And the reason they went through that is because of the real estate cycle. The real estate cycle for them, their demographic fell off a cliff. They had contraction in real estate prices, probably a little bit of deleveraging, credit destruction. That's that contraction phase. And now they're coming into recovery phase where most of the time they use a lot of stimulus. But they can't really you can't stimulate the house prices higher because you just don't have the demographic to sell into. Right now, if you look at all the other economies, they're all in an expansion phase and it's late cycles. So you can see India, Mexico, Brazil, US, Japan, Australia, Canada, Korea, and Eurozone UK. This is where they think they're located given the global business cycle. In a late cycle, so this is early, mid, late, and recession. In late cycle phase, certain investments do very well. And again, guys, I'm very attuned to where these cycles are at. And I'm just trying to gauge where maybe other people thought. We're definitely late cycle. You can tell we're in that location based off the yield curve and where yields are at and how it's inverted. So those investments that do real well, I don't know why it's skipping over that one. The investments that do real well in a late cycle expansion phase is basic materials, bond prices fall, commodity prices rise, late expansion, and energy takes off. And then we have inflation rises, and then short-term interest rates rise. Then we go into defensive sector, stock prices fall, which we haven't really had stock prices fall yet. We've got early contraction in consumer staples, commodity prices start to fall. Utilities do well in early contraction. And then late contraction, financials, consumer cyclicals do well. Bond prices start to rise, etc., etc. What's difficult with this cycle, though, is generally the cycle is paced by the real estate cycle. And that stimulus money that came into the system, I think, did cause a little bit of misreading. I think it's slowing down the real estate cycle prematurely. If rates were, I think, a little bit lower, and maybe that stimulus money put a little bit more inflation into the system, which it definitely did, we put rates to a level that may not be as sustainable for the real estate cycle to really take off massively. Because we need more participants and more sales to really push that to the upside. So right now Powell has slowed down the monetary expansion, but in the background we still have all this fiscal spending. So it's crazy, kind of what's going on with fiscal spending, and that is stimulative. We've got oil, platinum, silver on one chart, looking at when assets take off against each other and trying to tell where we're at in this bull market in terms of location. If we're in the late cycle movement here, so coming in, we've got oil here. There we go. So we have oil here, and oil has broken out of this consolidation to the upside, and I think we're going to go way up. This should correlate with where we're at in that expansion phase. It should all interconnect. I've got silver down here, and that's starting to work its way on up as well. And then I've got platinum on the bottom, which has been consolidating, looking like it could potentially go up as well. So when we look at these last bull market, if you look at the bottom of the oil market, I put this green line there. Silver didn't really go anywhere for a while in the beginning of that bull market. Then we had a big move in platinum. Platinum went up quite dramatically from 98 to 2008. It basically followed oil in that inflation move. We went through a recovery phase. In the beginning of that recovery phase, since they printed money, silver really took off. Platinum took off too when they printed that money. And then it went sideways. All three assets went sideways in the recovery phase of real estate, which again correlates with that business cycle above. But we bottomed in 2020. We can see a big move off the bottom of 2020 with that money printing in platinum, silver, and oil. And right now we're sitting on top of that consolidation, much like we were in 2001 or two. So that's where I think we're at, is like 2001 or two. I think we have a big move ahead of us in oil still. And that's kind of what I'm looking for. I'm also looking for platinum to take off. We haven't had that takeoff yet, but hopefully it's coming soon, and hopefully it outperforms silver. The reason I hope for that outperformance is because if we get a ratio that goes very favorable for platinum against silver, I can swap my platinum to silver and get a huge move at the end of the bull market of commodities in silver. And I would swap if we get that type of move. So hopefully it rhymes or mimics the last bull market here where platinum outperforms. We get a big outperformance. We get hopefully a very high ratio against silver. And then I can swap to silver potentially. We'll see. Or palladium. If palladium's bottoming too, we'll see what that looks like at that time. And it'll give me some options. But that's kind of what I'm seeing there in that market right now. Coming back down, we've got stocks to gold ratio, stocks to energy ratio. So looking at these, we've got the S&P 500 to XAU, which is gold, and I think this could potentially break lower. That is a potential there where gold will outperform the S&P 500. Why do I think that? Because of the late cycle expansion phase and then the eventual recession. The eventual recession will boost gold prices higher, and I think it will pull the S&P 500 lower. And that's where I think the outperformance will come from. This is the S&P 500 divided by US oil. So you can see this cycle going up and down. I put that sine wave in there, and I think we're at a high point where eventually this will fall and go to a low point. But that low point is out a ways. We could still stay elevated where the S&P 500 stays elevated against oil. And then I've got the low point. If you look at these low points here and kind of how they correlate to some of these low points, it's not a perfect fitting cycle, but it is a cycle that I kind of fit based off of where it's located here and how I kind of overlaid these. So the bottom would be somewhere like 2040 on that sine wave. And that's where the bottom of US oil would peak against the S&P 500. So maybe we're just a slightly bit early, where the S&P 500 is peaking-ish somewhere this year or maybe next, and then oil's bottoming against all of these other financial assets. So on the bottom here, I have the S&P 500, which is just skyrocketing higher, and then I've got oil on the bottom here in the blue. So what I am expecting is if you draw kind of a trend line through here, we've broken that consolidation. I expect oil to go up and the S&P 500 to underperform oil at some point here soon. This is the outperformance in the 1970s in terms of assets, and I've gone over this once before. So when gold outperforms, that means that you're in a certain market condition. We don't have that outperformance against financial assets. We are more like 75, 76, like we're in a slowdown where stocks are outperforming and tech is outperforming, than we are with gold and commodities outperforming. So I think we had that surge from the stimulus money come through where gold and commodities went up and outperformed tech because we had a pullback in tech in 21. That's when those interest rates went up. Then we went into a slowdown where stocks and tech are outperforming here in the short term. But I think we're coming back into gold and commodities outperforming out in the future. The reason I think that is because of where we're located in that cycle. Again, it comes back to that cycle. The expansion phase of real estate the expansion of the business cycle, the late cycle expansion phase. And eventually it's going to turn favorable for gold, where gold starts to outperform the S&P 500. That's why I went over that ratio chart. And commodities will be right behind gold in its outperformance, and energy. Energies and commodities. Coming on back. So we also have, this is the most recent data for outperformance of assets. And if you look at the 12-month, we have information technology, communication services going up a lot, financials, the S&P 500, industrials, energy for the past 12 months is up 17.66%. Materials, at the bottom is real estate, utilities. And again, this is a function of where we're at in the cycle. And that stimulus money, I think, has caused a little bit of a different movement, maybe. It's not as fluid as if it was being controlled and paced by the real estate cycle. That money coming into the system is inflationary and it may have pushed rates a little bit too high. So it might be shifting money a little bit differently than some other cycles. It might not be as steady of a move in commodities as it was in, say, the 70s or even the 2000s. But I think it'll come on back. It'll come in waves. RevCap says, I followed the gradual normalization of home prices in the Sun Belt closely. It's tracked supply trends. So supply is really driving it. It's finally tipping into more than normal supply, so price is flattening out. It could go negative in some areas, which I agree with. Northeast California still have a long, long way to go. So supply and demand, this is our supply demand of this area here. Lower score indicates a softer cold housing market. So we've got cold housing markets more in the south, and everything up north pretty warm and out in the far west. So we're still warm in some of these areas, basically from the middle portion of the United States and northward. It's been pretty hot. House price index inflation from 76 to 2023. Low point was 08, 2009, and all these areas. You can even see the nice little bottoming pattern that we got at the bottom there. Greatest time in history to buy a home was right here. And everyone compares these other higher areas to this area like, oh, you know, it's going to come back to this really low point. I'm not sure about that. I don't know if it'll ever go back down there or if it will go back down there in our lifetime. And this is 1 year price change by metro area. You can see a little bit of downward movement in some of them in 2023, but that's bounced back in almost all of the areas to positive movements of price appreciation. Coming on down, we've got metals weekly price and performance. So the metals prices, platinum outperforming the best, up about 4.5%. Palladium up 3%. Those two doing very well. I want to see platinum outperform. That also is telling me that this bull market is going to get kicked off here. At least it would mimic the beginning of the last bull market. Platinum outperformed everything, and then it's the most inflation sensitive asset. So if inflation's coming back, we should see platinum outperform. Palladium's the offset metal, but there could be other geopolitical things going on with palladium and Russia and stuff like that. Zinc, lead, silver, tin, gold's down a little bit. Manganese was by far the worst. Lithium still having a rough time, and uranium being the ones that pulled back last week. This is Michael A. Arat. He says, all clear now. What is this? So this is the shaded areas represent recessions as determined by the NBER, which is the Business Cycle Dating Committee. So these big upward moves from low points indicate these big surges in commodities. We had a big surge in commodities here in 02, 03, 04, all the way up to 2004. And then it started coming on back. I think we are in a similar situation to 2001, 2002 when looking at this potential move. So we're coming up, '02 is here when we went into positive territory, and that's looking like we're going to do that. We had a big surge in 2020, 2021. We remained elevated. We came on back. So our slowdown is coming during this time frame here, and it looks like we're recovering in 2024. So are we going to get a big move here to the upside for this business cycle movement? I think we will. Oil looks very well positioned. I'd like to see platinum really start to move here, indicating that this is correct and showing us that the business cycle, where we're at, and how this thing's moving back and forth. I think that this is the stimulus, and this is the stimulus overhang that I've talked about on the website. We could see a slowdown with the stimulus overhang. Now, we want to see the real estate market firm up here. We want unemployment to remain low. If we cycle back, we could cycle back. It's possible, uninvert the yield curve and then reinvert it later. That is a possibility still. But right here, this is an indication that it looks like we're going to go back into expansion phase and push commodity prices higher. But we'll see. We'll see. I'm going to skip that. We already went over that. This is a global rate cutting cycle in its early innings, which is weird here because we're heading higher with this data here for the business cycle. We're late cycle stage. We've got all this data, and then this data kind of goes against it. It's like, why are we cutting rates here? Global rate cutting cycle in its early innings, 11 central banks in easing mode versus 4 that are still tightening. EMU, CAN, Canada, and all these other ones are easing, and then we've got a couple that are tightening. So this is JPM Global Manufacturing PMI. It's over 50. We are growing in both of these. So that makes me think that we're coming into strength for manufacturing, not weakness, which is weird. And maybe this is going to give us an extra boost for commodities, potentially. But generally in rate cutting cycles, there's usually a slowdown or a problem. And they cut to increase or stimulate production and the economies to try to get them to grow. It says if you, oh, and I already, yeah, so if you listen to just one podcast this week, let it be this one, Howard Marks in a conversation. And I think that's kind of where I'm going to stop it. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you haven't already. But that's what I've got for today. We've got, oh, this will be released after the question and answer session we have later today because I'm recording this on Sunday, releasing it on Monday. So I've got nothing else to say, guys. So we'll catch you next time. This is Finding Value.